Well, it would be great if upon retirement taxation actually stopped for you, but the surprising thing is that many retirees find themselves actually in a higher tax bracket when they retire. My guest is Darcy Bergen, who practices in Peoria, Arizona. Thanks for joining us, Darcy.
Thanks for having me, Scott.
So when someone retires, the assets that they've accumulated now have to be turned into some sort of income stream. Talk about the 401k and how it's taxed.
Well, your 401k is a tax postponement plan. So when you take money out of that 401k, it's going to show up on your tax return. You're going to pay tax on it. 401k through work is not always the most efficient, doesn't have as many choices. So you may want to roll that over to an IRA. When you roll the 401k to an IRA, there's no taxes. It's a tax-free rollover. And then again, that IRA is going to be taxable when you touch it. So you want to make sure that you plan how you're going to take money out of the IRA or 401k and get it in your own hands after tax. So there are some definite tax strategies of how and when to take that money out of the account and actually pay taxes on it. One of the strategies is a Roth conversion strategy. If you don't need the income from the IRA, but you can get it out at the 15 or maybe 25% tax bracket, maybe you should start stripping the IRA and stripping the 401k down over the years to get the money out so it's after tax. So definitely strategies to reduce the IRAs and the 401ks.
And Darcy, so with IRAs, there are required minimum distributions, affectionately known as RMDs. Are there any strategies that actually reduce the taxation on these?
It is possible. RMDs, the required minimum distribution, has to start at age 70 and a half. And so a lot of people wait until they have to do the RMD, but most cases they shouldn't wait. You can delay your Social Security to age 70. So if you delay Social Security to 70, you delay your RMD till 70, both is coming out at the same time. That means you're going to pay a lot of tax on both. So you should do one or the other. Maybe delay Social Security, but maybe start taking money out of the IRAs as soon as you retire. Get as much money out of the IRA as you can so that when you turn on Social Security, you don't have as high of income, and so you're not paying as much tax on your Social Security, and you have lower required minimum distributions.
Darcy, finally, talk about how life insurance can be used to reduce tax liability.
Well, life insurance, if it's used properly in the right way, can create tax-free growth and tax-free income potentially. So, it's sometimes kind of like a super Roth. Income from a Roth is tax-free, but also you can generate money out of a life insurance policy in retirement, and it can also be potentially tax-free if done properly.
That's Darcy Bergen in Peoria, Arizona. Thanks for watching Retirement News Online.